Ray Dalio warns investors that the stock market may see considerably more suffering in 2023. In fact, Dalio believes cash today offers a greater relative return since he expects stocks to perform so poorly as a whole. In an exclusive interview with CNBC, Dalio provided his clearest explanation yet of the long-term debt cycle, how it influences how we engage in the economy, and how it can be used to predict how the economy will develop in the coming years. With a net worth of $19 billion, Ray Dalio is one of the most successful investors of all time. He primarily acquired this wealth by starting Bridgewater Associates, which is the largest hedge fund in the world. So it wouldn't come as a shock that his latest stock market crash prediction is something that we must look out for. Hey, welcome to Stock Market Mate. Today, let's talk about Ray Dalio's warning about the 2023 stock market crash. Before we get into it, do subscribe to the channel and hit the like button to help us beat the YouTube algorithm. If you're done with that, then let's get started. We'll start by sharing some snippets from the most recent interview Dalio gave, in which he discusses the long-term debt cycle and the types of assets that are most likely to do well in the future. Ray Dalio is one of the few persons we look to when we want to understand how the economy works because he does a great job of distilling the complexities of the finance industry into a few fundamental concepts, driving forces, and variables that ultimately shape what we observe and what occurs. Specifically, a production curve, a short-term debt cycle, and a long-term debt cycle make up the economic machine. An economy is the only culmination of several individual exchanges of money for commodities, services, and financial assets like stocks between individuals, corporations, and governments. The most straightforward concept is productivity. Humans improve their ability to produce goods and services through the acquisition of knowledge, which ultimately enhances our level of living. This is known as the productivity curve by Dalio. For instance, the knowledge we currently possess regarding the development of motor vehicles has led to a significantly increased level of supply chain efficiency, which has decreased the price of products and services and raised our standard of living. Long-term economic growth is fueled by productivity, but short-term economic fluctuations are caused by debt since it essentially permits us to consume more than we generate. In the short-term debt cycle, it usually takes place during a 5 to 8 year period when we have to pay it back. Debt usage is increasing, which leads to greater expenditure, which leads to inflation when consumption outpaces input. The central bank intervenes in this situation by increasing interest rates and reducing inflation. Because of the greater cost of debt due to these higher interest rates, people are compelled to spend more on their debt financing as opposed to spending money elsewhere in the economy. A recession results from less expenditure, which lowers prices. The short-term debt cycle will restart if the central bank lowers interest rates, that is, if inflation is no longer a concern. Since 1945, there have been 12.5 cycles of short-term debt, with the most recent cycle starting in 2008, the year the Federal Reserve cut interest rates to zero in response to the global financial crisis. When the pandemic recession struck again in 2020, it brought an end to that cycle and pushed interest rates to 0%. Yet, in addition to being in the midst of a short-term debt cycle, we are also just getting started with a long-term debt cycle, which normally lasts between 75 and 100 years.
There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
The beginning and end of these debt cycles, which span several decades, have serious repercussions for investors. While the amount of debt fluctuates in short-term cycles, very few people who are living today or no one who is alive today would have experienced it before. Moreover, it usually builds up over several cycles. Dalio claimed in his most recent memo that the extension of the long-term debt cycle has almost always been accompanied by an increase in debt liabilities and debt assets. This has always lasted until either the debt assets or the debt burden reached intolerably high or low levels. In returning, significant decreases in debt liabilities and debt assets occur as a result of a combination of debt restructurings and debt monetization. These are the major times of debt crisis. Simply walking through the most recent long-term cycle will help you comprehend what Dalio means when he talks about these cycles. That started in 1945 and just finished. The cycle of long-term debt has 4 stages. The first stage started in 1945, when World War II came to a conclusion and the United States firmly established itself as the world's most powerful military and economic force. From 1945 until 1971, this finally gave them dominance over both the economy and geopolitics. The American dollar was also backed by and linked to gold, so if you went to the Federal Reserve, you could practically exchange your dollars for gold. There were 5 short-term debt cycles throughout this time period, all of which were caused by the United States' excessive spending, which was financed by amassing more and more debt. Eventually, several nations with large gold reserves had far more claims on the gold than there was actual gold to exchange for US dollars. They began to convert their American money for gold, which essentially resulted in a US bank run. To cut the link between the US dollar and gold, the US essentially opted to simply stop holding enough gold to exchange for those dollars. As you may anticipate, today's fiat currency was established. From 1971 to 2008, this led to a sharp devaluation of the currency. There were 5 short-term debt cycles during this time, and the US currency underwent a significant devaluation. An enormous boost to asset values in 2008 came from each of these interest rate cycles that ended with lower rates than the previous one. Interest rates approached 0% as a result of the global financial crisis, signaling that the central bank would need to implement a new kind of monetary policy in order to revive the economy, because the maximum effect of interest rate reduction had been reached. The long-term debt cycle's final stage, where quick debt monetization occurs, was marked by the quantitative easing program that year, as the government required even more cash in 2020 to pay for its hidden stimulus checks. The Federal Reserve turned on its money printer and continued to buy a lot more government bonds. Again, trillions of dollars worth of government bonds were issued by the Federal Reserve, so what happened next should have come as a surprise to anyone. All of this extra spending caused significant inflation, which leads us to recent years, during which time most of us are probably well aware of the steps used to reduce inflation. Since mid-2022, the Federal Reserve has been raising interest rates, which has caused speculative stocks to crash and even the broader market to perform poorly. Where are we now then? Which asset classes do you think Dalio believes will perform the best in the future?
This market, depending on what you think this market is, it actually believes that inflation's coming down. And they don't believe Jay Powell to some degree.
I think what you're referring to is they don't believe what's in the curve. Or in other words, what's in the curve is a significant easing.
Yep. Right.
What Jay Powell is saying is steady.
Right.
Believe steady.
Mm-hmm. You're saying believe steady. You're saying
steady.
Believe what Jay Powell is saying.
Right.
As the yields in short-term rates are far greater than those in long-term rates, we can observe what is priced into the bond yield curve and therefore know this. But this runs counter to what Jerome Powell, the chairman of the Federal Reserve, has been telling investors about future rate stability. Although Dalio concurs, we believe that this form of recession is not particularly bad. The situation is far better than we anticipated it to be. Even if it is anticipated that rates would continue to be relatively high. According to Dalio, the potential 2023 recession won't be as bad as he initially predicted. He claims that the US's tremendous debt, which they are currently finding it difficult to sell globally, is the fundamental problem with the country. As a result, the Federal Reserve is forced to strike a very delicate balance between the debtors and inflation. They must have an interest rate that is high enough to provide real returns that are greater than the rate of inflation, while not boosting rates too much for borrowers, such as debt-ridden enterprises and governments. Value investors don't really care about the macroeconomics forecasts offered by experts like Ray Dalio. Particularly since, at the end of the day, even if he may be correct that, as a whole, stocks won't do as well as they have in the past, there will still be markets, industries, and sectors where businesses and investments continue to perform well. Your responsibility as a value investor is to look for these chances. Well, that's about it for today's video. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one.
If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!